Hi guys, today we're just going to do a few videos on finance strategies. We'll do one on cash flow management and liquidity or working capital management, one on profitability, and one on global financial management. Okay, so hopefully this will be of help to you. But before we start, we got to get into why we need financial management. And the core goal, like you should know from year 11, is profit maximization. That's the be all and end all of all businesses. And we have strategies to achieve it. But we also need our strategies to react to certain influences to achieve certain objectives. Okay? And these objectives will be our liquidity, which looks at our cash flow, our working capital. Okay? Our profitability, which looks at our profits, our growth, growing the business, efficiency, which is our outputs per inputs, and how quick we do things, and solvency, which is how we can pay off our debts in the long term. Okay, you should know these 5 objectives by now. If you don't, I'll be very worried. Essentially, these are the 5 things we're always looking at in terms of finance. Okay, why we do it? This is all in the slides that you have on Google Classroom, so don't worry too much. But essentially, we need to ensure our stakeholders are all happy, everyone's happy, the business can survive in the long term and can be successful. It's all begins and ends in finance. Like I said earlier, the actual strategies. We're going to do cash flow and working capital as one together. That'll be one video. Profitability will be a shorter second video, and global financial management. It might be a bit longer. That's a third video. Hopefully they're about 20 minutes each, max. Depends how quick we go through things. Okay, now, the first one we're going to look at is cash flow management. And that's all about the money we have held within our business. And it looks at not only our outflows, but our inflows of cash. Okay, now if we don't have enough, or if we have more outflows than our inflows, here, a problem arises. Okay, because I might not be able to pay off my debt. I might not be able to pay off my suppliers. A business would have to essentially borrow money or sell off its assets, like its non-current assets, to service it. Okay, so the business, because of that, needs to monitor its inflows and outflows. So what we're looking at in terms of inflows and outflows is all in this table here. So looking at sales, our cash from accounts receivable, commissions received, sale of our assets, so buildings, sale of our machinery, proceeds from issues of shares. So if we were to go capital raising, going on the share market, or getting a new investor from a private company, interest received from our own investments, and dividends received from our own investments. That's money coming in. But I could also have, and often I will have, money going out. So I need to pay my suppliers. Simple. Interest on loans, that happens. Operating expenses, so my wages, my rent, my materials, these are all expenses. Drawings, so this is where while my investors, while my owners takes money out of the business, because that's their money. Okay, we don't retain the money as retained profits. Purchase of assets, so buying new machinery, and loan repayments. Okay, so we have inflows and outflows. Pretty simple. Okay, so we're looking at cash flow management. The issue is we have temporary shortfalls. I have too much in outflows, not enough in inflows. And that could happen for a variety of reasons. We could have a poor trading period. I'm waiting on my accounts receivable. So from people who owe me, I'm still waiting on them. Or, so that's money coming in as my issue. It could be money leaving my business. So I have too many debts, or they all come at the same time. And often, you get this in life when you budget things, all your bills come at the same time. And that's all a cash flow management issue for you as a person. It happens as a business. Okay, now what can that result in is debt. I might need to borrow money to service my current debts or what I currently owe. It could lead to insolvency, when that's the worst case scenario, my inability to pay off debts. And essentially, when I have debt, interest rates. That's annoying. Okay, so we've got the issue. We've got to look at the ways to address it now. And there's 3 key ways. Okay, so first one will be distribution of payments. So instead of paying all at the same time, we'll spread our payments. 2, discounts. So if I pay back early. 3 is factoring. So getting someone to service my debts for me. Okay, so distribution of payments. This is where instead of paying all our things at the one time, so imagine we're a business and everything's due in March. I would want to try to distribute it between January, February, March, and April to make sure I have adequate cash flow for all those months. Okay? So instead of all bills coming in the 1 month, they will go on several months, and we'll try to match that with our cash inflows. Okay? So if you're a business that trades heavily in the Christmas period, I'd essentially want my inflows of my high inflows be matched with my high outflows in December. Okay, so that ensures I don't have any shortfalls. Okay, so that really leads to the last point. The business needs to be aware of high periods of high inflows and outflows, okay, to ensure there are no shortfalls. And essentially, these should be matched. Okay, so if I know my biggest bill of the year is my rent, and that comes in December, and my highest trading period is December, I'll try and match those so I don't have any shortfalls. Next one, discounts for early repayment. Essentially, this comes from 2 perspectives. We can look at it from the perspective of a debtor, which is someone who owes the money, owes a business money, so to its suppliers, or to someone who lends money, okay, or who offers a service. Essentially, what we're looking at is giving a discount for paying back early, and that will ensure I have adequate cash flow. So let's say a business is owed $250,000 in March. However, a shortfall occurs in January, a debtor, so that could be a customer, that could be another someone who buys my goods. I might be a supplier to them. They can pay back early for a discount. Okay? And what this does is that the person who owes money, they benefit because they pay less, and the business benefits because it covers their shortfall. It covers their shortfall in cash, which they can use to pay off other things. Okay? Now, the last one is selling off our accounts receivable, and that is money that's owed, okay, to someone else. And there's benefits and there's advantages and disadvantages to this. So I've used this in class before, and we'll do it again. So let's say we have person A. They are owed $50,000 from person B. Okay, now, person A, I got bills to pay. So let's say person A has bills to pay in Jan, but that owed 50,000 is due in March. Okay, so there's an issue here. We're going to have a shortfall of $50,000 in January and February. So this is where in comes a factoring business. So this is a financial institution that deals with factoring. It's a dedicated finance company. And what person A will do is go, hey mate, I need my $50,000. Okay, so what happens is $50,000 is paid to person A straight away. But it's not 50,000 minus, let's say factoring company needs to make a profit. So it's going to collect or pay out only 47,500 instead. Okay, so we're not paying 50,000 anymore, we're paying 47,500. Okay, I don't know what happened here, but we'll try to just go on. Okay, but to make money, the factoring company is over time, so in March when it actually is due, we'll get that 50,000 from person B. So what happens is the factoring company makes $2,500, and that's essentially its servicing fee. Okay, person A, hopefully we can still see, gets a cash flow in January, but they'll get less money. So they get $2,500 less. So I've used this example in class multiple times in relation to Jimmy and Anna. I don't know why, them, but sucks to be them. Okay, so the situation is Jimmy owes Anna. And Anna needs the money now. She wants new shoes, okay? She wants some really cool shoes. So to do that, she goes to the factoring company and they will pay her 5,000 that's owed. By instead of 5,000 being received, she gets a discounted rate. So 4,500 instead. Now, the factoring company will go to Jimmy when it's due, maybe in 2 months' time, and goes, oh yeah, we need that 5,000 that you owe Anna, but you gotta pay it to us now. Okay? So Jimmy needs to pay Anna that 5,000, and that's where the factoring company makes its business. So there are advantages and disadvantages. Factoring means the business can cover short cash flow, which is what we're looking at. The issue is that the business gets less money altogether. And if they can't actually get the money, the factoring company, the person that was owed is still liable. So they could lose out completely. Some case studies, we got Qantas. In relation to cash flow, they offer discounts for non-peak periods, increases money coming in. Okay, it's sales. It limits its expenses. So if you used to have aircraft that were due, it will delay payment to ensure that its cash flow position is healthy. Okay. Now, we're going to look at working capital management, and the reason why we're doing it together is that they're very related. Only issue here is that you may be confused slightly, but I'll try and make it as clear as possible. So, we're looking at working capital management, and this is where we need to have an appropriate amount of money, okay? Appropriate amount of current assets to pay off our short-term liabilities. So that is slightly incorrect there, so we'll just make a note. Short-term liabilities. Okay, so I would need to have my current assets to be able to meet my current liabilities. And you'd want more. So remember, we gotta go back to our liquidity ratio. And that is 2 to 1. Remember, we needed 2 times the amount of our current assets against our current liabilities so we can service it, but it also gives us profit opportunities. So that is an ability to invest with the money we have. Now, having that liquidity is also important to creditors, so those who loan out money. Okay, because they need to be confident you can service your debt. You have to have enough money available to pay off your long-term liabilities as well as your short-term liabilities. And if that's not there, it's going to be hard to get loans. Okay, now what we're really looking at is our indicator, is our net working capital. Okay, so I'll highlight that for you. Net working capital, that is one of our key concerns. And to calculate that is just our current assets minus current liabilities. Now, the next slide is going to look at liquidity ratio, which is similar but different. Okay, so if you remember liquidity ratio, you can probably skip ahead. But our liquidity ratio is assets over liabilities, and we want a 2 to 1. But our net working capital is not a ratio, it's a value, okay? It's a monetary value of how much we have left over after we factor in how much of our assets is relative to our liabilities, what we have left, okay? But the end goal for both of these is liquidity, the amount of money we have. Okay, so that was a bit of revision and to introduce it. But how do we actually manage it? And there's two sides of it. First one is our control of our current assets. Okay, and that's all the things we own in the short term, which we can liquidify, and our control of current liabilities, what we owe in the short term. Two rather simple concepts, okay? Assets, what we own in the short term that I can turn into money. Current liabilities, what I need to pay back in the next 12 months. And I'll just stress again that liquidity or working capital management is different to cash flow management. Cash flow management, this one here, is a part of liquidity. Because it's a current asset, okay? So liquidity management looks at a difference between current assets and liabilities and my ability to pay off my debts, to pay off all the things I owe, and my ability to invest. So they're slightly different. Okay, so control current assets, we can do this through three ways. We've got cash, we've got our receivables, our accounts receivables, and our inventory. While our control current liabilities, we have three ways. We have it through our accounts payable, what we need to pay, our short-term loans, and our overdrafts. But there's one more that we get in the syllabus, and that's called, that'll be our general or other working capital management strategies. So we've got leasing and sale and leaseback. And one thing you need to be aware of is that in the exam, you might be asked a question in general about working capital management, like that. And it could be any of these 8. But if you get a question about working capital management in relation to the control of current assets, it can only be these 3. In control to current liabilities, can only be these 3. But if you get one in general, it can be all 8, including leasing and sale and leaseback. Okay, so to get started is the control of current assets. And what we're looking at is the left-hand side of the balance sheet and what we can liquidify in the next 12 months. Okay, so first one is cash, our accounts receivable, and our inventories. And we'll break these down in a little bit more depth. Okay, so first one is cash. And the idea here is that we need enough cash to service our liabilities, or our accounts payable, or our suppliers, all our loans. We need to have enough. But we don't want too much. Okay? Now, if we have too much, I could be wasting that money. That money is just going to sit in my bank account and it won't make any money. It might make a little bit of interest, but not much. Instead, a business needs to look at its investing activities. So how it can use that for growth. How can I grow my own business? I can look at about stocks. So growth and investment in others. And I can do it on the money market as well. So that's with my bonds. Okay? So these are three alternative means. Growth in other businesses. I can purchase other businesses. I can put an investing stake in another one with my cash. Or I can use it for bonds. So these are essentially IOUs and they're normally secured. I can offer a certain amount of money to another business for their investment. And part of that agreement is that I'll get a certain amount, which will be a profit margin as well included, paid back at a certain day and time. Okay? And because we have this money being used, there's potential to make more money rather than just sitting in our bank account, not making anything and just being there as a waste. The next one is accounts receivable. And this is looking at money that we have on accounts with our customers and different vendors. Okay, so people who owe us money. Now, for a business point of view where you have people on accounts receivable, your goal is to get back your money as soon as possible. So your cash flow and your liquidity is there. Their goal is to wait as long as possible to improve their cash flow and their liquidity. So we have systems in place to try to ensure that accounts receivable gets paid back. So first off, we could also say discounts. If I really want that cash flow and liquidity. But we gotta think firstly about protecting ourselves, okay? And that's checking the credit rating. If a business we know aren't really good at paying off their debts, we might not even allow them to be a customer. We might not allow them to pay on an account. They have to prepay their goods and services. Okay? Now, second one is consistent accounts receivable systems. This is where we need to have systems in place to ensure our money is always coming in. So that could be me saying that all my accounts receivable need to be paid on the third Tuesday every month. Okay? That's a consistent date that all my vendors, all my customers know when they need to have their money ready. To follow on to that, we need to have processes to catch up on money that's received. Okay, so if they haven't paid by the third Tuesday, I have the process of checking on the fourth Tuesday each month, okay, to make sure they're paid. And I'll have probably extra fees. So I have that system to deter my customers, my vendors, from paying back late, okay? Next one is reasonable periods. I need to have enough time for a business to pay it back, or there's no point having payment via accounts receivable. And the last one is systems to collect bad debt. And this is where we need to have a facility, so a debt collection agency, recover our debts on our behalf because a supplier or customer has refused to pay. Now, there is a caveat to that, okay? So a caveat to that is that it must be worth it or the debt should be written off. So if you have, say, $200 owed to you, so let's say $200 owed, but it takes 1 hour to organize it, so time is money, yeah? So I could use that 1 hour to do other things. I can make more money in my activities, and there is a fee, a debt collection fee of $100. In that situation over here, it's not worth it. Okay, and you're better off writing off the debt. Okay, just ignore it. Say it's $200 in losses for my business. Now, there's a benefit of writing off debt as well, and that is it's a tax benefit because I have $200 less in profits. Okay, and that $200 will have a slight impact on my overall profitability. Now, last one is our control of our assets. Okay, so these are the things I own, the stock we have, and there's two sides to this as well. Okay, now a business can't have too little inventory, or that might mean that I can't satisfy the demand of my customers. Okay, the customers would leave because I don't have stock and they'll go to my competitor. But I can't have too much because when I have too much stock, it takes away my money. It's a cash shortage, a liquidity shortage. And the stock I hold, I need to hold it somewhere and keep it till it's sold. Okay, so we're going to look at two key issues in relation to this. That's our storage of inventory. I really don't want to be storing inventory for too long. If I hold it for too long, it takes up space, space is a commodity, so money, which I can't use for something else. And the second one is the type of inventory. If I have goods that are perishable, I cannot hold it for long, okay? I don't want to be spending too much on fruit and then realizing it's going to get all ruined because I can't clear it. Or if I stock up on a lot of trendy things like really cool shoes, the big deal for this season, I don't want too much because I won't be able to clear it to get my money coming in, and I will have spent a lot on it. Okay, now these all both need to be moved to avoid something we call shrinkage, which is an issue in operations. That's where we have stock that can't be sold. It's ruined, it goes as waste. Okay, and the idea is holding inventory limits cash flow and the working capital that can be used. And it really does relate to one of our operation strategy. What we got to do is look at how we can ensure our inventories are at the right amount. So one of the strategies to do so is a just-in-time inventory management system. Okay, this really relates to operations. It's an operations strategy, and that's where we will only order our stock when it is needed. We don't order it 12 months in advance. We order it 1 week in advance before I know I'm going to sell it. Okay, for a fruit shop, that's even shorter, maybe a day in advance. Or a restaurant, the chef would maybe go to the markets each morning to buy stock. Okay, now the last section is really our control of current liabilities. And here we're looking at the money that is owed for our business. Okay, it's pretty simple, this one. We're looking at our accounts payable, our loans, and our overdrafts. So first off is our accounts payable. And instead of trying to get our money back as soon as possible for accounts receivable, when we owe money, we don't want to pay it back straight away. We want to wait as long as possible because I'm using that money, I can make interest on it, I can invest that money instead of paying it back. Okay? So for a business that's owing money, has accounts payable, we need to hold it back as long as possible. But there are strategies as well, other strategies. So it could be having a discount. So if a discount's provided for paying back early, it might be better than holding it off for longer. Okay, so if I instead of paying in March, I pay in January, I get a 10% discount. I might not make 10% in investments, so it's worth it to pay back early. Second one is interest-free periods. And what we're looking at with interest-free periods is having a period where we just don't pay any interest. It's preferential for the business to hold this debt until the interest is paid. It needs to be paid, and that's when we start paying our debt. So this is like if you have a credit card, I would not pay it back until I need to, and that's when my interest needs to start being paid. And the last one is extended terms, and that's through loyalty. So if I'm a loyal customer to someone else, okay, to a certain supplier of mine, I'm a loyal customer. Instead of giving 3 months to pay my accounts payable or my invoices, they might give me 6 months. Okay, and that gives me more time to pay it, and that improves essentially the financial position. It improves the liquidity, it improves my cash flow because I'm not paying it back till later. And if anything, I can time it right. So think back to cash flow management, timing it to match my inflows. Okay, and last part is that we need to pay back to avoid penalties. Now we can extend on accounts payable as well, and this is through what we call trade credits. Okay, and there's two ways. One's a floor plan, one's consignment financing, and this is essentially when a business receives its stock from its supplier and it can either pay back at a later date or once they've actually sold the stock. So this is really prominent in, say, supermarkets, but also, say, a car dealership. The car dealership gets its car, okay, and it will sit on the showroom floor. That's why we call it a floor plan, okay? It's there so people can see it, touch it. They can get interested in buying the car. But the dealership hasn't paid the manufacturer yet for the car. It will only pay the manufacturer once an agreed date is set, maybe in a few months, or after clearing the stock. Okay, so these are accounts payable strategies that might be beneficial to a business, depending on its situation. Before we finish, we've got loans. So second last one about control of current liabilities. And what we're looking at here is that we need to take loans to grow a business, to invest, to purchase stock, okay? But our loans need to be appropriate. And we want to try keep our loans to a point that we need to minimize the cost of them. So, two key costs are our interest rates and our establishment and ongoing fees. Okay, interest rates, thankfully in Australia right now, they're only 1.5%. But in, say, 2007, they were around 8%. Okay, and that's all interest that needs to be paid. And that is the official cash rate. The banks will have their extra margin, and you'll be paying about 4 or 5% as a business now. Back in 2007, it was about 10% interest per annum. So these are all costs that need to be controlled. Okay, so it needs to be monitored. You need to pick the right loan from the right bank to be the most cost-effective option. So the first part is looking at the lowest interest rate. Okay, so we're looking at 3%, 4% rather than 5%. The second one is flexibility. And by flexibility, we mean instead of being a fixed loan, say paying $100 a month over 10 years, I could pay it back early. Okay, so that's ability to pay back early. And when we pay back early, we don't need to pay interest. If my loan is settled after 3 years, instead of the 10, I don't need to pay interest for the other 7 years. And this really relates to favorable terms that match my investment. So if I have a car that I plan to use for 10 years that has a profitable, that adds value to my company, my business, I will try to have a loan that goes for 10 years rather than a 20-year loan. Okay? So I don't have to pay back for something that isn't even making me any profit. Last of the control of current liabilities is our overdraft. So we know overdraft is like an overdrawing facility with your bank. Okay, and that's where my balance is negative. Issues that are that it attracts fees, but it's relatively low cost compared to loans. Because the loans, remember what we said before, have establishment fees, ongoing fees. While an overdraft is literally just paying the interest involved, which is normally quite high. So we have strategies to deal with it too. Okay, so we have systems to ensure that accounts receivable is paid from debtors, and we're really just using it to address our overdrafts. So what we have owed from people that owe us, our customers, our vendors, that money can go straight into our overdraft, and we reduce the timing issue involved. So we might not have an overdraft for long because you pay normally per day when you owe money. Secondly, we try to match our inflows to our overdraft as well. So our sales. Once we receive our money, we'll pay off our overdraft as soon as possible. Because what we're trying to do here is minimize our liabilities to improve our liquidity. Okay, so that is our control of liabilities. We've done control of assets, what we owe, control of liabilities, what we owe, so own and owe. And now these are our two general strategies. Our first one is leasing. Okay, so instead of buying things, buying my long-term non-current assets, which will take away my money, instead I will lease it. And sure, in the long term, I'll need to continually pay back, but I don't have that massive hit to the money in my business. Okay, so we keep our cash as our current asset. We maintain liquidity. Now, airliners such as Qantas, many airlines around the world will do leasing to ensure they have adequate liquidity and cash flow, but also to address their needs, to address the operational needs throughout the year as well. Okay, the school does it through our leasing of our printers and photocopiers. The second one is sell and lease back. So that's where if we have a non-current asset, so a building that we own, we will sell it off, okay? And that increases my liquidity, my cash, because all that money from a building, millions of dollars, goes into my business now. Okay? That money I can use to pay off my liabilities. That also improves my liquidity, my working capital management. Only issue here is that we have less assets in the non-current sense, so less non-current assets. And in the long term, I'll need to continually pay for that business now, pay for the lease. Okay, so a case study is Qantas. It controls its current assets through, it doesn't buy many planes, so it improves the cash situation. Its accounts receivable. It charges you its tickets straight away from its customers. And you get discounts for pre-purchasing extra things. So like when you fly with Jetstar, you get your baggage, you get your food. If you pre-purchase it, you get a discount. Okay? Now, our current liabilities for Qantas. Accounts payable for new aircraft. They have favorable conditions to pay off its jets with Boeing and Airbus. And they'll have strategies to pay off its vendors. Now, its other strategies, its general strategies, It leases aircraft. So its actual passenger airlines, planes, they don't actually lease them. Qantas actually owns them. Unlike Virgin, who lease their planes, and New Zealand, who lease their planes, Qantas actually buys them. But it's freight operations. So it's freight to send across the world. It actually leases those planes. So Qantas has a few 747-400 freighters. And the last one is sale and leaseback. So the terminals in Sydney Airport, Sydney Terminal 3, where Qantas flies out of, it actually used to own the terminal till 2014, I believe. And it sold it back to Sydney Airport and leased it back. So through that, it gets a lot of money coming in and improves its liquidity position. But in the long term, it needs to pay it back continually. Okay, so there are different options Qantas has undertaken.